We are honored to have with us today Steve Oswald, the CEO of Ducommun. Ducommun's headquartered in Costa Mesa, California. It operates in two segments, electronic systems and structural systems. Ducommun has 15 million shares outstanding, trades around $90 for a $1.4 billion market cap, 190 million of net debt for a 1.6 billion enterprise value. We're delighted to have Steve with us today, and he'll give a brief overview, and then we'll sit down for a discussion.
Okay, good morning, everybody. I'm going to spend about 10 minutes just giving you a brief overview of the company. Thanks for having me in. It's good to be here. I have to just say one thing. I want to thank you for having this at the Harvard Club, just so everyone knows that the last time I left this building, I was a married man. Okay, so I got married here. I haven't been back since. So, you know, hopefully it'll go as well. It's anyway, so thank you for that. Yeah, I haven't been a long time. So, okay, just real briefly, just so you get to know a little bit about Ducommun. I know some of you might not know the story. We have a proud heritage. We're the oldest continuous company in California, so we've been operating, had the doors open since 1849. Started as a very humble general store. And Ducommun is a Swiss name. So Charles L. Ducommun came to New York in 1843 as an immigrant, spent some time here, and then decided to go west. And back then, you walked across the country, okay? So it took him 9 months to walk across the country, a Santa Fe Trail. And luckily, he got there and found a store. He was a watchmaker. He apprenticed in Paris making watches and got out to California and said, I don't think this is going to work. And so then got into picks and shovels and helped out the gold miners. So anyway, so rich history. I just want to mention that, and we're proud of it. This is our 176th year in business, so happy about that. Here's just a little bit of our journey. I started with Ducommun in January 2017, so I've been here just a little over 8 years. You can see at the end of the fiscal year where we've been. We're pretty proud of our performance, our market cap. Been through, obviously, the terrible MAX crashes, COVID, some other things. And so we like where we are. We're looking for a lot more, but we think that's pretty good, and we appreciate all the support. Throughout the years, you can see our revenues, adjusted EBITDA, and EBITDA percentages since that time. So thank you for that. Top left is just a little bit of our business right now. You can see the LTMs. We lean more into defense, so a little more defense. We think that's a good thing for investors, but we have a lot of commercial as well. So I think we have a good balance as we move forward. We'll talk a little more about that. We're more narrow body on the commercial, though we do have a very good franchise with the 787. So we do have pretty good on the wide bodies. You can see all the platforms and things that we support. One of the exciting things is we've known in the press is the missile business that we have. Our missile business is significant across many, many programs. We make cards and we make cabling. And also we make actuation for missiles. And we're on all the legacy ones and some of the new ones. So we can talk about that during the Q&A. We're primarily a tier one, so over our revenue, we're over 50% tier one, but we do a minority in tier two, but a pretty good level as well. So just a heads up on that. We report out as electronic systems and as structural systems. You can see the numbers left to right there. And some of the products, we not only, as you can see here, made the complex cards and the wire harnesses, but we also do very good work in engineered products, which we can talk about. That's, I think, one of the exciting things of the story is that our engineered products businesses, since I've been with Ducommun, has grown significantly. Now we're 23% of revenue. And so if you think about HEICO, you think about Lohr Group, you know, a quarter of Ducommun now is pretty much those type of products with those aftermarket profiles. So and we started at the time, we were 9%, so we went from 9 to 23. So that's good news. That drives a lot of margin improvement. And then our structural side as well. We do, on structures, we do things that are really hard to do. So if you think about, well, you know, structures, is that good, is that not good? There's a lot of tough stories for investors and structures. We tend to make things that are small with lots of volume and hard to make. So titanium, we do make some larger parts through stretch form for fuselage skins, and that's a good business for us in the A220. But, we generally tend to watch what we do and be very thoughtful and make sure we have some pricing power as we go forward there. So that's a little bit of our segments. Our Vision 2027 has been with us now for a couple of years. We came out with this after COVID when we could figure out some assumptions that we think would work, that would hold. For the most part, I think we did a pretty good job. You can see that we're not going to get to $1 billion on the revenue. We'll probably get close to $950 because one of our assumptions was not right, that we thought Boeing would do better. And then Boeing had that terrible loss of the door and the strike. And so that put a dent in my $1 billion plan. But, we're going to get close to $950. And I think the exciting thing for investors is our EBITDA margins. We've gone quite a bit already as we just get halfway through this vision statement, and we should get to 18%. So we're feeling good about that. And in the middle is kind of how we do that. And we can talk more about that Q&A. Key investment highlights. I won't spend a lot of time on this. We can get to it in Q&A, but we'll talk about our engineered product strategy. Lots of good things in and contract manufacturing cost reductions. We have our M&A strategy we can get to. We do have a great defense story, which again we'll discuss. We are differentiated, and the nice thing is we're very limited on tariffs. So we have a slide in here, but the story is positive there. I do want to just spend a minute on engineered products. That's 23% of our P&L. You can see that we've done 5 acquisitions. You see at the top there the dates we bought these companies, and the other 3 I inherited when I started in 2017. Overall, it's been a great thing for us, a great thing for investors. These companies, we not only buy them, I think, at a good price, but then we grow them. We can talk about that when we get to Q&A. So a lot of positive things here. Our commitment is to get to 25% by 2027. We're going to do better than that. And that's just all, margin expansion everywhere when we put one of these companies in Ducommun. On the contract manufacturing side, we did close 2 factories the last couple of years. That's not something we just want to do. We want to grow business. We don't want to close business, but these things just didn't have any future, in my opinion, so we closed them both. And we're moving some of that work, and we're expanding our Mexican operation. We have very good productivity down there. It's a lot of handwork. We make the MAX spoilers now down there, so we make all the spoilers for the MAX. It's a big ship set, all those spoilers for the 737 MAX, and so now we're going to make it all in Mexico. We used to make the front end in Monrovia, California. Now that's all moving, and that should be great. M&A strategy, again, when I came in, we had very little aftermarket at all. We had very little pricing power, very little sole sourced products, and that just wasn't going to get us where we need to be. So that's why we've been very disciplined and vigilant on just buying these type of things, and you will see more of that. You're not going to see us buying a pump company and industrial or something else. We're firmly committed to A&D. Customers, overall, you can see just for Boeing, you can see the ship sets at the bottom, which I think are interesting. These are all the ship sets we have for DCO, and you have Boeing, Airbus. We think good things are ahead for Boeing. I'm sure you're hearing that from other CEOs. I feel like they have the right leadership now. There's destocking. We'll hear destocking in the next 6 to 12 months. It's still not going to be great, but we're on our way. And I think all good things ahead for the industry and for investors. Airbus, also we've got a very good relationship, and we've been with Gulfstream and BizJet, other Bombardier, et cetera, for a long time. On the defense, we'll get to this in the Q&A, but defense is straight up for us, for missiles especially. We're getting calls from Raytheon. You know, they call it the call to action. So we're on call to action meetings. I've never been on a call to action meeting since I've been here for 8 years. But now I'm on a call to action meeting, so I get on the call. I make sure I'm available. And what they're telling us is that, you know, watch out. I mean, you know, we're going to go straight up on SM-3, which is Standard Missile 3, you know, Standard Missile 6, you know, all the things that we have a really good part of the franchise there. So really good things on that. We're doing our offloading, just real quick on that. That's, you know, basically we have a strong relationship with Raytheon. They trust us. So now they're moving product out of their operations to our operations. That's very delicate for an OEM because they want their parts and they want them right and on time, and sometimes all the best intentions, it doesn't work out, but we've proved ourselves that we can do these things, so that's positive. And then new stuff as well. We're on a lot of the new things, and we'll see how all that plays out, CCAs, etc. I'm not going to spend too much time on this, but this is just, again, our contract manufacturing businesses. We make titanium, really tough things, cards, ruggedized interconnects, and we do a lot of chem mill and stretching, and we also have a VersaCore composite, which is an IP product we have, and we use that for the LEAP engines on the A320 family. So we got a pretty good franchise on the nacelles for the LEAP. Just a second on tariffs. You can see here from the chart, we've got, we're pretty much a U.S. manufacturer, always been that way. Again, we have the facility in Mexico, which I think is going to be good for us as we go forward, and we're going to scale that up. And, you know, we're fine on our Airbus business, shipping to them. We ship into Toulouse, and with recent agreements, we're fine there. And for Mexico, we're under USMCA. Okay, so again, again, we'll talk about this, but these are some of the highlights. And you can see the Vision 2027, which I've talked about. We'll, later this fall, I'll get with the board, and we'll start working on, probably be a Vision 2030, so we'll come out with that next year for investors. We'll update everything, and you know where we want to go, okay? So I'll leave that there and look forward to speaking with Tony. Thank you for your time.
Great. Steve, that was a great overview. Thank you for doing that. That'd be perfect, yeah. And maybe anyone in the that's in the back of the room that would like a seat, there's a lot there are some available seats up here if anyone wants to move up. Yeah, well, that was a great overview. Let's start with call to action. I like that phrase, and you know, you've talked about this, but you know, strong growth in the defense business over the past few quarters, highlighted by the missile segment as a big driver, with revenue up 39% in the second quarter. You know, is that sustainable? I mean, we've seen, you know, Raytheon, Lockheed talking about doubling production. Jimmy, just give me your thoughts on that. There's a lot of moving parts here.
Yeah, sure. This one okay? So everybody hear me okay? Okay, yeah. So, yeah, we had a great second quarter. I'm not sure it's going to continue to run rate in a year from now, 39. It might. Okay, you know what I mean? You know, it might, but. You know, this is sort of a very unusual thing for at least for Ducommun and on our missile franchise, where you know, we're having phone calls, and you know, the president of Naval Power is on the call, and I'm on the call, and they're like, for instance, you know, this Standard Missile 2, we make 2 a month. Okay, we make very little. They kind of just spoon feed you, right? Just so you keep the business going, and you have the tooling and everything. And we get on there a month ago, and we have someone from Huntsville, Alabama, who's the general for the missile business or the missile agency there, and we have Barbara, who runs Naval Power, and a bunch of suppliers. And pretty much what he told us was that, you know, we've used all these missiles, or a lot of them, to defend Israel. Okay, you know, and all the Iranian missiles that were coming in. Okay, we use a lot of SM-3. And so, you know, basically they told us you need to quote 25 a month from 2. And, you know, so I'm always a bit skeptical when I deal with the government because they're going to break your heart at some point because you're going to, so I think it's more like 15 a month, but going from 2 to 15 is like a big deal, right? And, we make the back end of that, we make the actuation, Mode makes some of it, then we put it all together. It's called the TVA, and that's the back of the missile. It's a really good program for us. So what does that look like for a Ducommun? Well, the nice thing is we make it in Huntsville, Arkansas. We make 2 a month, and we would just flow. We put a flow line in our factory. We have room, and we make 15 a month, and maybe more than that. So that's just how we think about it, and that's Standard Missile 2 as well, Standard Missile 6, Tomahawk, PAC-3, PAC-2, Patriot. I mean, these are all things that, at least, since I've been there for 8 years, this is a different world. Yeah.
That's eye-opening.
Yeah, so it's exciting. Yeah.
There's probably a lot to still talk about there, but let's talk about the commercial aerospace business and the destock. So you mentioned from Boeing and Spirit impacting your commercial aerospace revenue trajectory through the year end and into 2026. How do you see, what's your view on how that plays out? And then I assume the ramp, I think, the ramp is probably the bigger picture.
Yeah.
But
yeah, I think, look, we're, to Boeing's credit now, I'm on a monthly call with the head of Boeing Commercial Aerospace Supply Chain, Ishan, and the program leads on the 87 and the 37, and they've made a real effort. I mean, obviously, it's a night and day from what it was a year ago, so that's all very positive for investors in the industry. I mean, right now they're actually doing 38, and I believe the number. I think that's appropriate. What they tell me is for them to go from 38 to 42 is no problem. I mean, that's a layup for them. Okay, they said, but for them to go from 38 to 47, which is their plan for mid next year, is going to be harder. Okay. Now the good news is that the old 787 building in Washington, where they took it out and they moved everything to South Carolina, okay, that's empty. They're now putting in a MAX line. So they're going to put a new 737 line right in that building. And it's a wide building, right? So sometimes when you're building these things, you have problems with seats. You have problems with all different types of, it's just not, a structural part. It's a lot of other things. So that's going to be, I think, a big lift for them. I think it's going to, be operational probably by May or June. And so, that's going to be a big shot in the arm. So I think that, they're telling me that 42 in November, they're going to get FAA approval. That's probably in the cards because they've been doing a nice job in their metrics. They have a KPI, 6-pack KPI thing they work on. And so I think that's all positive for them. And then 47, the problem you have right now is that they're building at 38, but we're seeing like 27 or 28, right, overall, right? So, we got headwind, and we're going to continue to have some destocking headwind. When I asked them about my parts, I got on the call, I raised my hand. I'm like, the only person that asked the question is like 100 people on there. I said, can you tell me my stocking position for my parts? And they said, sure, send us a letter. So, of course, I get up the call, and I get with my people. I have 40 part numbers. I'm like, please tell me, all the stock positions so I can plan my business better. Well, it didn't really work out for me. They came back and said, well, we don't really have 30% of them we've got a year plus. 30% of it we've got like 6 months, and the other 30% we need like tomorrow, or we have like 2 months. So just so you know, for the destocking, it's not like everybody is like at 9 months of stock, it is like all over the place. So that's why this thing's going to be lumpy. I don't want to speak for them, but I think, if they get up to 42 and then start going higher, it's going to help. And I think probably by mid next year into the Q3, we're going to see hopefully a much better one-to-one, right? Boeing to supplier. Is it going to be 100%? No, because there's always going to be a tail on something, right? It's just, maybe in 2 years it'll be different. But overall, the story is very positive for DCO and for the industry.
Looks pretty good. You expressed optimism for a strong second half of 25. You sort of talked about it here before, but what are the key drivers behind this outlook, and how confident are you in the visibility of these orders?
Yeah, great. So we committed on the call in August. we're going to do mid-single year-over-year and low double-digit in the fourth quarter year-over-year, okay? So, you know, we feel like even though destocking is going to be still with us, and we feel like with our defense business, and, you know, I showed you those factories we closed. Well, we had to move everything, and then you had to get it approved by the OEM, right, which takes time. Sometimes it takes a year. So we're finally at the tail end of that. So that's going to be another positive thing, because we have products right now that are not being built because they're waiting for approval from Boeing, from Raytheon. But they're going to come online now in September, October, November. So that's going to be a shot in the arm for us. So that's also going to help. So it's defense, maybe a little bit more on commercial, you know, probably, you know, slightly. And then these 3 or 4 programs, which, by the way, when we put them in these new factories, they got much better pricing and much better cost profiles, right? Because they're not being made in some huge plant in California where it was half empty, and, you know, we had lots of overhead and high energy costs, and, you know, so I think that's all going to be positive for our margins. It's not there yet, but it's coming.
I think, again, you sort of talked about this in your opening remarks, but you made great progress on EBITDA margins, and then you have your going up to 16% over the last 2.5 years, key drivers going forward for your Vision 2020 to get to 18%. Maybe you could just dig down a little further and just walk through all the moving parts of getting to that number.
Yeah, so look, you know, we've had good progress. Again, just, you know, for investors to know, like, you know, yeah, we bought these companies, you know, maybe we paid 10 times, 11 times, 9 times, whatever. But once we got them, we grew them, you know, a lot of them, okay? You know, not everything was a total home run, but a lot of them were. So we're actually, for instance, you know, we bought this magnetic seal company in Rhode Island. And so we bought this company. It was family owned. 2 brothers owned it. You know, they passed down from their dad who passed away. They were not involved in running the business. And so we were able to win it. The Houlihan brought it to market, and we won the business. And pretty much, you know, we did like just a couple of things. We gave them $1 million to buy a grinding machine for their seals. So when we gave them the $1 million, they actually almost doubled their production, because all their machines were like 30 years old. You know what I mean? And the brothers are not going to come up with $1 million, right? So that's when you say, well, how does this thing actually work, you know? And then the other thing is they had all these goofy distribution agreements, which went through middlemen and, you know, everything else, and they're taking their share. So we basically, you know, politely and the appropriate time said, you know, we're not going to do that anymore. And, you know, so with the production increase and everything else, you know, I don't know if we've doubled the business, but, you know, pretty much we bought the business at 10, you know, multiple. It's probably a 5 now. I mean, and that's only been a couple of years, you know. So you have to just know, it's not like, oh, we got to go buy another company so we can put it in there and it can look better. And, you know, we want that, but we really want to take these things and build them. So that's one thing. The other thing is on our contract manufacturing. You know, I've been at this game now for 8 years, right? So, and it's a tough business, contract manufacturing. So you take a lot of bruises and some disappointment. But, you know, now we're really at the point where we're driving our costs lower, but we're also telling politely the OEMs, look, you got to pay us this or you got to go somewhere else. You know what I mean? Like, you know, we're not going to do anything inappropriate with a Raytheon, you know, and whatever, but we're just not going to take things at 5%. We're not going to take things with a wish list like, okay, we're going to take it at this and hopefully 5 things happen and we can make 10%. We're not just doing it. It's just, it doesn't work. So that's on the CM side, that. And then our M&A strategy, I just looked at something, you know, it wasn't that great. I mean, it was something we could probably buy. It was $100 million, roughly $80 million. It was, you know, they had 350 people. It was like a $30 million business or something. Like, you know, I mean, so there'd be a huge disruption, huge this. And even though we probably would have been in the top 2 to win it, we passed. You know, do I want to pass on stuff? No. But, you know, we only have so much money to spend, and we don't want to get something that we're going to regret. So I think I've got just one other thing if I can spend. So I'm here in New York. I'm going to Long Island next week, and I'm going to visit a company where she inherited from her dad, or she bought out her brother. She's 2 years away from selling it. I'm going to go out there and drive out on Monday or Tuesday, have a little lunch, say hello, and then hopefully in 2 years maybe we can, you know, have some action on it. You know, so we do that, just as a proprietor versus just getting the bank books and everything. We try to find these things that, you know, a lot of them are really good.
Yeah. You know, maybe I'll ask one more and I'll open to the audience. But you know, you talk about minimizing your supply chain risks. You did a good job of moving facilities to you know, Mexico and labor constraints and, you know, minimizing all that. What else? What's sort of the next phase? What's your next echelon of improving that the cost efficiency there and stabilizing?
Yeah, sure. So a couple things. You know, supply chain is tough. I mean, supply. You know, one of the things that, and Raytheon deals with this is, like, for instance, these Amphenol sells connectors and other things. They got a really good business, and when they have these connectors, they're sole sourced. Right, so you can't use anything else. You can't go off and use a plan B, you know what I mean? So, you know, when we're making these cables, we got to buy their connectors. So, you know, you get pushed from the other side too, right? You know, because the OEM is going to drive you down because that's their job, is purchasing people, and they want more money. And then the other side, you have sole source suppliers on the back end that are going to say, hey, here's my price every year, and sorry, you know, that's what it is. And if I was running Amphenol, I'd do the same thing, you know. So, you know, I think we do overall a very good job on supply chain. We do commodity management. I'm sure you guys know that. And we're very, you know, we do try to lock up supply. We don't want to have a lot of things out. But the other thing I'll tell you is we don't do long-term LTAs. We don't. And we don't do life of the program ever. Okay? Life of the program, you know, is something that if you sign up for it, whether you have a pricing dispute or not, you have to still ship. I mean, it's like, so it's a whole nother. So we have none of that. We try to keep very loose and flexible. We have commodity management teams in place. And we're continuing to try to improve that. So I think overall, it's positive. Our people, you know, if you look at our revenue per employee the last couple of years, it's gone like straight up. I think we have a really good culture. We don't have a lot of people. I mean, we got maybe 2,200 people, you know, that kind of thing. We don't, you know, we got, you know, that's our setup. And our sites, just so you know, we have 15 sites. Every site just does one thing. So site does the cards. Site does the cable. Site does titanium. You know, we don't have anything where there's 700 people in a big building and they're doing 3 different things, and I don't like that. I'll never sign up for that, you know, and I kind of inherited it. I got lucky. But we've kept that, you know, sort of thing. So I think on the people side, culture side, I think we're in good shape.
Pretty good. I'd like to open it up to the audience. Sir.
How are you feeling about the M&A environment? You mentioned, obviously, you've been buying at 9, 10, 11 and growing it to 5, but it just feels like there's a lot of PE money coming in and that everyone's kind of looking for roughly the same assets, aftermarket, IP heavy. So we'd just love to know, and obviously it's a strong market. I mean, where do you see realistic multiples for the businesses that you're seeing?
Yeah, I mean, back in 2017, when I first started, the lobbies were a little less crowded. You know, the lobbies are much more crowded now, you know. And unfortunately, you know, we had a little bit of a benefit early on because when you're buying a 30 or 40, $50 million revenue company, you know, back in the day a little bit, not everybody was looking at it, right? Because people said it's too small or it's not for us. Well, now, you know, everybody's looking at stuff. So the lobbies are more crowded. I think, you know, realistically, the multiples are 11, 12. You know, you see people paying 17, which we would never do. But, you know, sometimes those things happen. I think, you know, the flow is still good. I think it's, you know, who knows, you know, the future. But there's a lot of companies out there that, you know, maybe aren't like $500 million companies. I know there's less of those, and a lot of them gone private. But the things that we want to do to build Ducommun, you know, from my point, they're out there. You know, there are these like 30 million, 50 million. There's something coming on the board. I met with their owner in Paris Air Show that's going to be out in September, October. It's perfect for us. It's like $40 million. You know, it's a good EBITDA business. So, you know, we're going to take a hard run at that, hopefully. Overall, it's good. You know, and things are more expensive, there's no question. And, you know, you hear it from other CEOs, I'm sure. Everybody's talking about engineered products, you know, especially with Lohr and, you know, with their multiple. And, you know, you can't blame them.
The 30 to 40 million, that's valuation or sales?
No, that's sales. Sales, yeah, sales.
Okay. Well, that was a great overview, Steve. Thanks for coming. We love having you here, and hopefully get you back next year. Great job.
Thanks for listening, everybody. Okay, enjoy your lunch. Thank you.
Investors should carefully consider the investment objectives, risks, charges, and expenses of the ETF before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit www.gabelli.com. Risks to the ETF include a downturn in commercial air travel, production and/or supply chain disruptions, decreases in defense spending, subcontractor financial health, and competition and/or technology changes.